Brad Thomas here with TheStreet. I'm joined today with Clint Halverson, Vice President of Investor Relations with Extra Space Storage. Good to see you today, Clint.
Thanks, Brad. Thanks for having us.
Sure, glad to be here. Well, listen, let's start talking about the REIT market today. We've seen with a lot of the bond proxy REITs, what I call the triple net REITs, we've seen those sell off. We've seen prices decline by as much as 20%. However, your company and the self-storage industry in general has not. What's driving that today? Is it because of the shorter term leases that you're essentially month to month leases today? What's driving that?
I think the interesting part about storage, Brad, is that it's a need-based product. It's not an iPad. I can't go out and talk someone into buying storage. But if you look at the long-term history for rental trends, storage has very stable rental demand. There's needs in good times, there's needs in bad times. And storage has done phenomenally well through both the good and the bad times.
Sure. So your company now has grown significantly. I was looking at some numbers. You had around over 600 units, I think corporately owned back 5 years ago, and now you're up well over 700 and some change, and close to 1,000 units, including your management model. So significant growth. What's driving that? It seems like a lot of fragmentation out there. Are you buying these one-off deals? Are they larger portfolios? What are you seeing out there?
There's a couple of things that have really driven our growth over the last few years. Primarily, we're big into partnerships. We like partnering with good companies that can help us in our growth model. And years ago, we partnered with companies such as Prudential Real Estate. And over time, the focus of those funds have shifted, and we've been able to buy some of those assets back to be wholly owned that we had owned in joint venture before. So that's one avenue that we're seeing some growth. Another area, during the downturn, a lot of owners didn't really feel their properties were getting the value assessed to them that they felt they were worth. And so that's when we started our management model. We got big into management. And now we're seeing as cap rates have compressed and as prices are a little more attractive, we're seeing more buyers bring their assets to the market. So we're seeing a lot more movement in the storage market.
Sure. So you've been buying a lot of assets. How are you doing that today in terms of your balance sheet? What's your availability in your credit facility? And how are you raising money today?
We've had a strategy in the past to go for it leverage neutral. So debt to equity, try and keep our debt levels around 40%. And we've looked at it recently, and we've gone a little bit heavier to the equity model. Earlier this year, we did a convertible bond offering for $250 million that we've used to finance our deals. Also, we're finding in the storage market, a lot of the owners of the smaller owners of storage are first-generation entrepreneurs. They've built this asset. They're very, very emotionally vested in the asset. And we're finding that OP units are very attractive to these owners. It's a way for them to do some tax planning, to kick that tax can down the road a little bit, as well as continue to get a cash flow and a stream through the dividend on their OP shares. So we found that to be a very successful way to buy properties.
Well, you mentioned the dividend. I think that's another differentiator for your company because not only does Extra Space lead the sector in terms of the highest dividend yield, but also in terms of the dividends that are increased. I think you had a 50 or 60% increase here in the last quarter. So what's driving that dividend, and what have you guided the street in terms of your dividend this year?
So in the past, we've looked at our dividend to just meet our taxable REIT minimum and to kind of move forward with that. This year, the board looked at it and felt we're doing well. We feel positive about the future. And as I mentioned, we're looking at these OP unit deals, and we felt that by increasing the dividend slightly, become more attractive to these folks that are looking to replace a cash flow they've had in their asset. So we look to increase the dividend. I don't want to get out ahead of the board and say what they're looking to do in the future, but right now we're paying 40-cent dividend, about a 3.9% yield. It's pretty attractive.
Sure, it is. Well, finally, I always like to talk about my favorite subject, especially for your company, is innovation. We don't see that a lot in the REIT world today, but I believe that one of the big drivers for your company has to do with innovation. Can you touch on that a little bit?
No, I'm glad you asked, Brad. That for us, we feel is a differentiator. We're renting space, but how do we differentiate ourselves? And we look at ourselves very much like a retail company. We need to get in front of the customer when that need arises. And as I said, need arises, people don't go out and window shop for storage. So we need to be there at the right time with the right customer at the right price. So for us, technology has become very, very important. Innovating in how we get in front of that customer is very, very important. And I think it's those companies that can harness technology and leverage technology to be in front of the customer and focus not anymore on the channel. Is it a walk-in customer? Is it an internet customer? But focusing on the lifetime value of the customer that comes to you and pricing accordingly to capture that customer. That's going to be the game changer for storage, is using that big data environment to really leverage that lifetime value of a customer and give them the right promotion, the right price at the right time.
Great. Well, Clint, it's good to see you today, and I hope you get back when you hit a number of 1,000 units here very shortly.
Thanks, Brad.
Thank
Appreciate
you.
it.